The McIlvaney Weekly Commentary, covering monetary, economic, and geopolitical news events. Now here are Kevin Orrick and David McIlvaney.
Welcome to the McIlvaney Weekly Commentary. I'm Kevin Orrick, along with David McIlvaney. David, we're talking to you via phone in Orlando. I know you're meeting with clients, and you're on your way to the Bahamas next week for private consultations with clients. I wanted to mention something. There was a Wall Street Journal article just a couple of days ago, speaking of firms going long, manufacturing firms going long on the products that they think they're going to be using over the next 3 to 6 months. Did you see that article, David?
Kevin, it was interesting. We talked about it a little bit on Friday in our comments on our wealth management website. And the point was this: they're increasing stockpiles, and to look into the details of that, I think, is pretty important, because essentially what the rise in commodity prices has done is turned your major manufacturing firms into speculators. On the one hand, this may be prudent for the CFOs and CEOs to be organizing their purchases this way, but it's worth discussing anyway.
Well, speaking of speculators, what are they speculating on? Is it their sales are going to be increasing, or is it that the costs of making those things that they sell will be increasing?
That's the latter, Kevin. When you've got resources that are increasing in price, and these are your basic input costs going into manufacturing goods, what they're doing is stockpiling both those resources, but also the finished products themselves. So you're seeing inventories get quite bloated. And again, what some would describe as strategic, others as opportunistic, if they're speculating on the price of the commodities that they're stockpiling. And some might even view it as a necessary precaution, Kevin, to avoid having to pass on those higher costs to a very wage-constrained middle class. So that's, I think, the real cost to be looked at is being unhedged from a rise in input costs, because it can very quickly squeeze your margins.
Well, David, you think about some of these companies, you don't think about spices going up, but McCormick Spice Company has pre-purchased a lot of extra spices, and cotton has been skyrocketing. You mentioned last week that the price of wheat was contributing to the unrest in the Middle East and in Asia. So it seems that we have price inflation right now, but it doesn't seem like the consumer here in America is really feeling it. But manufacturers, at least the smart ones, are seeing ahead of time, and they're looking down to the end of the horizon, and they're saying, I'd better buy it now, or I'm going to have to raise my prices later.
Well, it is a bit of a balancing act, Kevin, because if they don't do something to hedge those input costs, then you're looking at sort of absorbing those higher costs and it impacting profitability significantly. It's eating into profitability. If the price move is considered short-term in nature or something very cyclical, then generally they'll just absorb it and try, a very reasonable increase, if they can get away with it, in the cost of the consumed product. We've seen that with the Snickers bar shrinking in size. We've talked about the cereal boxes, my favorite, of course, also shrinking in size and them changing the color scheme so that you can't see or perceive the change in the size of the box.
Right.
There's those games which can be played, but the real risk is to be the first to raise prices and shock the consumer, leading to a shift in purchasing habits and a loss of market share, because those have long-term consequences. If you end up driving away the consumer that you spent so long fighting for in the marketplace, the odds of getting them back are pretty slim. So that's the greater risk, Kevin, losing competitive advantage as they move from one product to another. Again, successful marketing is about bringing those consumers into the marketplace to buy your product as opposed to someone else's, even though there's not very much difference between the two of them. And price can be something which is very disruptive if that price increase is noticeable. So nobody wants to be the first to raise the price, and so there is that idea, perhaps we can just hedge it out by buying or stockpiling it, and so you see corporations doing something quite similar to what we've seen several Asian and North African countries do, stockpiling significant quantities of commodities. In some case, they're consumable. In some case, they're industrial and will be consumed, but not by the belly as they're put into products.
So, David, is this something that we can consider to be a cyclical price increase? We all know that there are seasonal cycles and sometimes supply and demand cycles, and they come and they go, and oftentimes they will go away. Or could this be, portent of something longer term?
It's interesting, Kevin. You look at a chart of the CCI today, the Continuous Commodities Index, or the CRB, and they're both moving up significantly. CCI to recent highs again. And to me, you're looking at a short-term inflection point, perhaps lower. You've got everyone who's now going, quote-unquote, long the commodities, and it's a good time for those markets to take a step back. We may, in fact, have had the reason for that here in the last day or two with the central bank in China raising rates yet again.
Mm-hmm.
Third time in a very short period of time, trying to cool off their economy. We'll see if that has an impact. Certainly, at least here in the first couple of days since that decision, we are seeing a bit of an impact into the copper market and some of your industrial commodities. So it would be normal to see the commodity index drop back. But I think what the CEOs and CFOs of your Fortune 500 companies are considering is not a cyclical move higher, Kevin, but maybe even a structural move higher in commodities. And, it would be very similar to what we saw in the 60s, where finally copper stepped out and broke out to new levels. And as we moved into the 70s, it got into nosebleed territory, but it was a new plateau. I mean, up until the 60s and 70s, it had been range-bound, that particular commodity, and it finally broke out into a new kind of stratosphere, and we really haven't gone back since then. So is that what we're in the process of doing? That's probable. How probable, we'll see, but I think the odds are pretty strong. There are some issues to be dealt with, though, and some details to consider.
Well, that takes me then to the retail sector. You've got inventories seeming to be expanding right now. That also would be interpreted by the mainline media as people looking ahead and saying, hey, business is back, we're in a recovery, let's go ahead and expand our inventory. Is that what we should read from expanded inventories, David, or is there something else behind the curtain?
Well, to me, Kevin, you're taking on a significant amount of risk because you're still in an environment, and we'll talk about this in a few minutes, Kevin, but the two elements of unemployment and housing are really significant still, and it's worth considering. If you're manufacturing new goods to be sold, what's the likelihood of turning over that inventory quickly? If you're not going to turn it over quickly, then you've got issues of that inventory either being rendered obsolete or you have to sell it at a steep discount. So instead of stockpiling the commodities, manufacturing it, accruing your costs on that kind of product now with the idea that you're going to save yourself billions or add to profitability in the billions of dollars, guess what? In fact, you end up taking it on the chin. So what looked like a smart equation ended up not being so smart simply because there was not enough inventory turnover.
Okay, so what we're seeing then, both on the manufacturing side of things and the inventory side of things, may be a little premature because we're not really necessarily seeing a pickup in consumer spending, are we?
Not adequately, Kevin, and I think when you look at unemployment and housing, you can clearly see why. So to recap, Kevin, we do have a pickup in manufacturing, which in our opinion does not relate directly to the return of the consumer to the marketplace or robust economic environment, but we feel that the next wave of products that will be available will be at a steep discount. If you're talking about retail products in the second half of 2011 or the first half of 2012, you're talking about a steep discount as retailers try to move products that they were sort of filling the pipeline with maybe a little too early.
So maybe what we're seeing is a prediction from you that this next Christmas season, this shopping season, there's going to be steep discounts on items, a little like we've seen in the last year or two with the so-called financial crisis, where prices are cut so dramatically that it looks like there's an increase in sales, but really the profitability of the companies has just gone right out the window.
Yeah, I think for 2011 and 2012, giving gift cards could be pretty smart because not only will you get the after Christmas discount with those gift cards, but you may even get a pre-Christmas surprise in terms of discounting.
Well, David, that leads me to the question of employment, because the unemployment numbers, they've been publishing much better unemployment numbers. In fact, suspiciously better unemployment numbers. Now, a person can't really go Christmas shopping unless he's employed. We've talked about this before. You can only get so many government bailouts. How about the unemployment numbers? Are we seeing an increase right now in the job market of employed members to that market?
Well, I think this is where something definitely needs to be clarified, because while we look at U3 and U6, the standard unemployment numbers, and those numbers seem to be improving from 9.6 to 9.4, now U3 is 9%, that would imply that people are going back to work, when in fact that's not the case. As we pointed out on this last correction from 9.6 to 9.4, the change had to do with people coming off the unemployment rolls. In other words, they'd just been on so long that they fell off and were no longer counted.
Right.
That didn't mean that they actually had jobs. And you can see that reflected, Kevin, if you look at recent Gallup polls. There's quite a different story being told in the unemployment numbers. And we could talk about that in a minute. But the biggest issue with this last correction down from 9.4 to 9%, which seemingly is a spectacular move in the right direction,
right,
is there's really one factor, maybe two, but one significant factor which contributed to that, and that was seasonal adjustments. When statisticians put these numbers together, Kevin, there's extraordinary things that they want to take into account. For instance, in the fall, you have a seasonal adjustment which is applied because you've got an excessive amount of purchases made in light of kids going back to school. In the wintertime, of course, you've got Christmas, and it's out of the normal buying pattern for people to be buying as much as they do coming into the Christmas holidays. So these kinds of things tend to distort economic activity, and so what the statisticians have done, they've created these adjustments to accommodate that. Here's the real issue, Kevin. We had John Williams on the program a number of months ago, Kevin, and this is some of the work that he's done, is looking at both the benchmark revisions and the seasonal adjustments. And the point that he makes is that these seasonal adjustments are particularly healthy and helpful in the context of a growing economy. But when you're in a recession, they're using the same seasonal adjustments that they would in normal times, and it tends to distort the numbers greatly. In fact, Kevin, the number would have jumped, this is U3 unemployment, would have risen to 9.8% from 9.1% in December if it were not for the seasonal adjustments. So we actually have the opposite thing happening. The unemployment situation is getting worse, not better, and yet the number is saying that it's actually getting better, which is going to be heralded and has been advertised broadly by Wall Street as further significant evidence that we are, in fact, in recovery.
You know, David, what that reminds me of, I've gotten in the car in the past and not necessarily known the direction that I was driving. And for a period of time, this has probably happened to many people, you drive the wrong direction thinking that you're maybe driving east when in reality you're driving west. It's pretty embarrassing when you do it, but it's not devastating. But what we're saying right now is we're really heading south on the employment numbers, yet the people that are listening to the statistics right now are thinking that we're headed north.
Well, that's exactly right. And I think this is one of the things that really skews an investor's judgment is that they're assuming they're working with legitimate numbers.
Right.
And the more I study on China and issues of investment opportunity there, the more you realize how important solid information is. And there's virtually none, particularly on that front. Having good fundamental analysis on Chinese companies is impossible. We just got China's GDP numbers, Kevin, and they were, in fact, better than 2009.
Weren't they over 10% this time?
Yeah, 10.3, up from 9.2. So again, things seem to be humming along nicely in China. But again, there has to be some suspicion laid on the veracity of the numbers themselves. And, the error measurements that I think can be applied to the Chinese GDP numbers could be anywhere from 2 to 4%, which again, if you're moving out over the next 2, 3, 4, 5 years, or even looking back over the last 2, 3, 4, 5 years, if you were off by 20, 30, even 40% on your total numbers, then no, the economy has not grown quite as interesting as some think. But I think one of the things that came out of the recent numbers from China, Kevin, had to do not just with the main GDP number, but particularly retail sales. It ties into something we'll talk about in a bit, which is banking issues here in the United States. The retail sales in China, Kevin, fell in the early 90s and have never recovered. They fell from 45% of GDP to 36% of GDP. And everyone is hoping and assuming that we will see the consumer in China be the next great driver of bull markets, both here in the United States and around the world. They're supposed to be the driver of recovery. They're supposed to be the growth engine of tomorrow as the lead in the emerging markets, and we're just not seeing it. And the most recent GDP figures, Kevin, from China would say so. The two areas that saw significant growth in terms of retail consumption were, interestingly enough, gold, silver, and jewelry, which rose by 46%. And, of course, right in line with the real estate bubble in China, you have furniture, which is up 37%. You have appliances and audio-video equipment also up 27.7%. So a major boom in certain areas, Kevin, but complementary to significant issues that are there. The significant issues being, one, real estate, which for our minds are clearly in a bubble mode, not unlike 2005 and 2006 in the U.S. But with inflation comes an increased demand for investment dollars flowing into gold and silver. And, Kevin, we saw that in India, where the investment component in India, the growth there was shockingly high for 2010. And it's not a surprise that in China as well, the investment demand for gold is off the charts. Those of the World Gold Council actually think that we could exceed, China's consumption of gold could exceed India's this year or next year. So we're talking about massive quantities, between 600 and 800 tons of gold per year in terms of consumption per country.
And David, as far as the production of gold, we've talked about this in the last few weeks. China has now become the largest producer of gold in the world, surpassing even South Africa. Yet they're consuming twice what they're producing or more. So we're not really even seeing this increased production. It's never even really coming to market, is it?
No, in fact, you've got over 300 tons which is produced and consumed, in addition to that 209 tons which was imported this last year, and on top of what they produced. So the numbers are moving significantly. And the investment environment is such that people are sensitive to inflation. They're sensitive to gold as a real asset class. Whereas in the West, as a result of generations now, certainly decades of indoctrination and re-education, investors look at paper and paper only as legitimate asset classes, whether that's stocks, bonds, insurance products, or what have you. Whereas in other parts of the world, with a little bit more connection to history, in frankly less developed financial markets, they still have a deep appreciation for the metals themselves. Silver, right in line with gold, has seen a massive increase in imports and in consumption in China, Kevin. So, both metals, the story of growth in China, if it were me, I wouldn't be looking at the Shanghai Stock Exchange as much as I would the consumer demand for the metals in light of monetary policy starting here in the United States and being very impactful throughout the world.
Once again, you're listening to the McAlvany Weekly Commentary at McAlvany.com, McAlvany.com. David, it seems to me like we've got a spine or a theme running through this, both with what we were talking about when we first started the show, with manufacturers buying goods in an effort to try to defray inflation of what it's going to cost to manufacture their goods down the road, trying to buy them now. We've got the Chinese who, we're being told there's huge growth in GDP, but a lot of that growth in GDP is inflation hedging, people buying gold and silver. Now, there's a thought in the Chinese markets right now that whatever loans that these banks that are giving out, which there's a tremendous amount of borrowing in China right now, but whatever loans they are, whether they're non-performing or not, it can just be evened out over time a little bit like it was a decade ago. Now, David, the people who were here in the 90s and saw the Chinese banks come back out of the 90s relatively unscathed, is that something that we could see again, or is the consumer someone who loses this time?
Well, I think just in review, if you go back 10 years, you had 20 to 40% of loans in the Chinese banking system which were non-performing loans.
Wow.
And that's a massive, massive amount of non-performing loans. But ultimately, the two things that helped them out of that dilemma, the vast number of non-performing loans, was aggressive recapitalization by the banks, in addition to gross domestic product, which grew at an average of 10% per year.
And that was funded by our consumption on this side of the Atlantic or the Pacific, wasn't it?
That's correct. So the U.S. consumer, in essence, was partially, you can contribute the U.S. consumer partially to helping bail out the Chinese banking system. There are several things, though, Kevin, that I think are worthy of note, because it really was the Chinese household which has been behind the curve for 10, 15 years now. And it's worth mentioning because I think the U.S. household and the European household is in a very similar position today, Kevin, because we have some similar themes going on. Incredible fragility in the banking system, both in the ECB and in the U.S., and it partially explains why the European Central Bank and the Fed are keeping rates so incredibly low. They're keeping rates incredibly low so that they can rebuild the balance sheets at these significant banking institutions. Again, that has echoes of China circa 1993, 94, 95. So if you were looking at the crisis in banking in the 90s in China, you realize that a tremendous amount of wealth was transferred from the household sector to those banks in order to repair the banking system. And they did that primarily through the difference in interest rates. Keeping rates incredibly low basically robbed the household or depositor of interest income. And that spread, the interest instead went to the bank directly. Which, again, how similar is that to what we have today, Kevin?
You know, I think about the older people who we talked to who thought they were going to be able to retire on CD or interest income. And at this point, they're having to go and get a job, maybe in their 70s, maybe in their 80s, they're having to get a job because interest rates have been unnaturally kept low for so long. And you're saying that this is really just a bailout straight to the banks.
Yeah, there's a finance professor at Peking University. I've mentioned him before in past shows. Michael Pettis is a fascinating character and writes a regular piece for a private institution. We're fortunate enough to take a look at that. But some of this thinking was distilled by him, Kevin, and it basically was 3 or 4 different solutions that the banks had in China, and our banks have too. One was what we saw in the 1930s, where you just simply default on paper. You know, that 20 to 40% of non-performing loans, or the loans which we're currently keeping off balance sheet, which the FASB has allowed us a free pass on, and is just completely ignoring in terms of current market value. You know, thus the credibility of the banks remain intact, and the balance sheets appear to be healthy. We're just not looking at any of the bad loans. So that is not likely to happen. What we saw in the 1930s, where you simply default and the depositors absorb the full loss, that's not likely to happen. You know, alternative is a government bailout followed by an increase in taxation. And we've certainly had our fair share of that in the United States. You know, and that does tend to spread the cost evenly. This is what we've referred to in the past as debt being democratized.
Right.
And then in the context of collapse, the consequences and the risk being socialized, where all households bear an equal weight of the loss through an increase in taxation. But where banks begin to come ahead on this is where you manage interest income, and instead of that interest, short-term rates going to the depositor, they go to the bank instead.
Well, you know, that question has come up many times when a person says, how come I'm only getting 1% or maybe 2% on my CD? But when I go to take a loan out, even a mortgage loan, which is unnaturally being kept low, you know, it's 4, 5, 6%. That seems to be quite a profit from the saver, the person who's putting money into a CD, and what the bank is making on interest.
Yeah, so not only does the banking industry benefit, Kevin, but our whole debt structure benefits from rates being kept artificially low. It's an interesting concept if we can explore it a bit. The idea of there being something of a resolution to our debt and an absolution of our debt by these rates being kept so extraordinarily low. And again, I credit Michael Pettis with putting these numbers together, but if your rates are too low by 4% or 400 basis points, over a 1-decade period, you're looking at the equivalent of a 25% debt forgiveness.
Wow.
And if your rates are too low by 8%, which is, of course, an extraordinary amount, but assume that the risk implied in a certain market is something like 9%, and the current going rate is 1%. So that 8% differential where the debt's being priced 8% too cheaply, in a matter of a decade, you're looking at a 50% forgiveness of the total stock of debt. You have to wonder, is that what Bernanke has in mind, both a rebuild of the bank balance sheets? Certainly, he's not only head of our money system, but also of our banking system. And so you would expect him to defend tooth and tongue the system which he serves and certainly rebuild it first, even if it is at the expense of the consuming middle class, even if it is at the expense of Joe and Susie Lunchbox and the interest income or the retiring class, which depend even more heavily on their interest earnings.
So what you're saying is this debt forgiveness is actually paid for by the common man. And even still, the common man who's done things correctly, who has saved money, who's put money in the bank, who's trying to earn interest. These are not people who are necessarily going further and further into debt. These are people who actually have saved a little bit of money and are trying to find some way of either preserving it or making it produce growth or income. Well, that common man is basically shifting any interest income that he would normally get over into bailing this system out. So that is, it's not true debt forgiveness for the person, it's debt forgiveness for the bank, isn't it?
Well, exactly. You're talking about a direct transfer of wealth from household depositors to banks and borrowers. And as that wealth is transferred, Kevin, the unintended consequence is into household consumption. And I think that's, again, where you can look at the Chinese and say, okay, they went from 46%, 45% of GDP being tied to consumption, and it's dropped to 36%. Why? Well, again, they've rebuilt their banking system and put themselves on a different trajectory, but at the cost of households. And to realign their economy now is going to be difficult. We are at the front end of that, Kevin, where we are seeing the direct transfer of wealth from depositors to banks. And the question is, can there be anything but a contraction in consumption as a percentage of our own GDP, which implies this, Kevin. It implies a very significant step sequence. There is no way for the U.S. government, Treasury rather, to issue less debt in the next couple of years.
Sure.
They'll be issuing more and more debt. And as we look at $14 trillion and consider, throwing in Fannie Mae, Freddie Mac, and your student loans and your other off-balance sheet fundings, Kevin, which brings our total national debt, instead of the $14 trillion, $14.3, which it's capped at, we actually have $20.7 already. 20.7 is our official public debt, and you can even get that from the Treasury's website, Kevin, where they do, in fact, count Fannie Mae, Freddie Mac, the student loans and off-balance sheet funding as a part of the total stock of debt. So we're playing games with ourselves if we assume that we're only in debt to about 100% of GDP. We've far surpassed that already, and we'll need to continue to issue IOUs to make up our difference in spending versus income. Well, again, Kevin, if it's the household that is contracting in their consumption, you know that government has to step in and spend that much more to make up the difference, so that our GDP numbers do not, in fact, go into the red.
Well, and you're talking about the issuance of treasuries. It would be far healthier if we were issuing treasuries and actually selling them to people who were buying them other than ourselves. The Federal Reserve, isn't the Federal Reserve, which is our own people, our own government, basically, even though it's not a government entity, the Federal Reserve is the largest holder of treasuries right now in the world.
Well, that's the scary point, Kevin, is you would like to think that it's a real market, and it's not a real market. Between other central banks, which typically have bought treasuries for political reasons, not as an investment, but because it opens up trade agreements and things of this nature, other central banks are a large component holders of the treasuries that we've issued. But the single largest, as you just mentioned, Kevin, the single largest holder of treasuries is the Federal Reserve, which is scary. I mean, you realize how much of a non-market the Treasury market actually is. But it underscores one other point, Kevin, which is this. We saw massive buying in recent weeks in Eurobonds. We had the issue of European Financial Stability Facility bonds, and this was about a $61 billion offering, which was bought up largely by Asian banks and central banks. There was 500 bidders, and this is the first bond of this type, but $61 billion worth of bonds snapped up with quite an appetite. When we talk about the treasuries that we have in the United States, our debt, when we talk about the dollar and how fragile it is, you realize just how important the euro is to our foreign creditors. The fact that Asians were buying up these bonds left, right, and center should send a very clear message to investors that they have no intention of letting the euro fail.
Yeah.
They don't want it to fail because they don't want to remain with the dollar-centric monetary system that we've had since the 1940s and Bretton Woods. So, Kevin, there's radical things occurring both in the debt markets and the currency markets, but it is a telltale when the Fed becomes the largest holder of treasuries. In my mind, Kevin, that is a significant tipping point.
David, I was just thinking what an irony. We just talked earlier about how China is not only producing the most gold, they're buying the most gold, okay? And yet, at the same time, we're producing the most debt, and we're buying it back from ourselves because we can't sell it to other people. So you wonder how sustainable it is when somebody's producing paper out of thin air and then buying it from themselves. And the opposite side of the ocean, they're producing gold and buying it from themselves.
Well, Kevin, I think it's worthy of note that just here in recent weeks that the Chinese Industrial and Commercial Bank of China, the ICBC, penned a deal with the World Gold Council to create what was called the ICBC Gold Accumulation Plan, ICBC GAP as it's been called. And, this allows investors to buy as little as 1 gram of gold per day into the equivalent of a savings account. and they can either take delivery of that gold or they can just accumulate it in the plan as a savings program. And when you've got the government encouraging investors to buy gold and silver in that economy as they deal with being tied to the U.S. economy, our consumption, our export of inflation globally, and the implications into the foreign currency market of our inflation being exported globally, this is an investor base that just says, well, we have to do what we have to do.
Sure.
Even if it's 1 gram at a time, we're going to save our personal balance sheets. I think it's fascinating, Kevin, that you are on the cusp of changes in China. We're not there yet, but we're on the cusp of significant changes in China where the consumer has more money to spend, where instead of the household taking it on the chin within China, instead of the household paying the price for manufacturing growth in China, you do have shifts taking place. Shifts we've talked about in recent weeks, Kevin. In early January, we talked about one of the largest provinces in China raising their minimum wage between 18 to 26%. Mm-hmm. These are massive, monumental shifts because what it means is that for the U.S. consumer to now buy those same Chinese goods exported from China, imported into the United States, we have one more version of inflation on our side of the pond. Not just monetary inflation stoked by the Fed, but now price inflation stoked by rising wages and rising costs to the goods that are being exported from China. The U.S. consumer ends up getting squeezed on several fronts, not only on the backs of the U.S. consumer or the banking industry, is the banking industry being rebuilt, but we're also going to face higher prices with consumer goods as well. So the one area we were sort of on balance seeing deflation, if you will, because even though we might see monetary inflation on the one hand, it was offset by cheaper goods being imported and made available to us at distribution centers like Walmart. No longer. Those prices move up, too, in lockstep. I wonder, Kevin, when the U.S. consumer isn't going to wise up, as the Chinese consumer and the Indian consumer already has, to the necessity of owning gold. The necessity, not the option. It's not another asset class that maybe it's in favor, maybe it's out of favor. Maybe you want to own it, maybe you don't. Maybe you believe in the long-term story of gold. Maybe there's no veracity to it whatsoever. But we're moving to the point, Kevin, where it's simply necessary as an insurance policy. That's the way we've always looked at gold, as an insurance policy, but one that is absolutely critical to any portfolio in any quantity. I look forward to the day when the World Gold Council can accomplish the same thing that they did with the Industrial Bank in China and do that with an HSBC or a JP Morgan here in the United States. I just noted that JP Morgan here in the last week is willing to take your gold. Interestingly enough, JP Morgan is willing to take your gold and silver as collateral on loans. So they can appreciate the value of gold, but they like it as collateral to loan you money.
That's the kind of collateral that I would take, David. I have no problem loaning almost anybody money right now if they want to put up the same amount of collateral in gold. How about you?
That's right. It's a different arrangement, Kevin, when the ICBC is encouraging ownership of gold and not putting your gold in hock. I mean, so we are making progress here in the United States, but not much. And I think it's going to take something radical, either in the interest rate market or in the currency market, to have U.S. consumers wake up to the fact that gold is, in fact, a necessity.
David, there's a fascinating chasm just talking to people here in America versus talking to people overseas in understanding of gold and what role it plays in preserving assets. Here in America, there seems to be just almost a dearth of buying of gold. You know, the price of gold, when we see it fluctuate on a daily basis, we all know has virtually nothing to do with American buyers or sellers. They seem to be asleep. It's the Asians, it's the Middle Easterners, it's the Europeans. They seem to understand at a much quicker pace, probably because they've seen currencies fail before and don't have the luxury of a reserve currency. But they seem to understand and be moving this market. Even this market correction that we're in right now, David, I'd like to hear you comment on it because it's been shallow at best. We really haven't had a true, good old-fashioned market correction in the gold market in a long time.
Kevin, I mean, it's fascinating because the average correction over the last 10 years off of new highs has been a minimum of 15%.
Right.
Yet the largest was in the fall of 2008, a 30% correction before gold recovered and finished the year positive for the year by about 5 or 6%. So, even in the worst-case scenario, the drop was overdone to the tune of 30%. Kevin, I mean, you look at this as a correction. You almost say, what correction? It's down 6.5 to 7% off of its peak. I would relish the opportunity to buy at much lower prices and the market has been stubborn. Often we'll look at the platinum group metals and silver as the leading indicator for how deep the correction would be. And look at palladium, look at silver. Are they taking a nosedive? Is silver off $1.25, $2 per day, 5 days in a row, where we've covered 25, 30% in a very short period of time? That's classic silver moves on the downside. Haven't seen it.
Yeah.
What about platinum and palladium? You've got palladium still north of $800, Kevin, off of a low of 160, and it's not giving up any ground. It's been very, very, very stubborn. And these, again, are generally very volatile metals that give up a lot on the downside very easily. So the question we would have is, are the market dynamics changing? Are we getting closer to moving from that, what we've described as a linear movement, 2 steps forward, 1 step back, to a parabolic move in the metals? Kevin, I think we could see prices move much higher. And for anyone considering the gold market, I think your risk is not being in the market. I don't think your risk is on the downside. But the charts that you need to be looking at are the charts of tomorrow, not yesterday, where we look at price action moving higher and not lower.
So, David, what you're saying is maybe back away from trying to micro-time this market. This may not be the time frame to be out of this market just to save a few extra percent.
Well, in a word, what a shallow correction in gold, the correction that we've had being incredibly shallow, is that the market is just remarkably strong, absolutely strong. And we've gotten some support in recent weeks from the events happening in the Middle East. But if you'll note, oil has sold off significantly as the headlines have waned and they're less sensational, and gold has not given back any at all. Neither has silver, neither has platinum or palladium. So your stress metals are not under stress themselves, even as some of the pressure and tension is being relieved in the international political market. So I think, Kevin, the bottom line is simply this. I mean, we have inflation globally. We have inflation in the United States that have for years, but it's been covered up by cheap goods that have been imported from China in the third and developing world. And that is largely going away as the input costs are on the rise and as the minimum wage costs are also on the rise. Kevin, in China, you've got everything from gold, jewelry, premium tea, stamps, calligraphy, art, jade. Everything is surging as you would expect to see it surge in a classic inflationary environment. And we have not seen the classic inflationary environment here in the United States, largely because people impute so much value to official government statistics. We talked a little bit about unemployment. We talked about those numbers being adjusted. In the past, Kevin, we've talked about the CPI weightings in the United States. It's absurd. We look at health care, and as a part of our inflation number in the United States, it's 6.5% of the health care number. Meanwhile, it's 17.6% of GDP. Kevin, health insurance, which is something that we all look at and generally absorb 20 to 30% increase in costs every year, makes up less than 0.5% of the CPI index. It's patently absurd, but this is the issue. Inflation is sneaking up on the rest of it. Inflation is sneaking up on Americans. It's not sneaking up on the rest of the world. So you have people buying gold and silver as a defensive posture against the consequences of inflation everywhere else in the world. Why is it not happening here in the United States? Because we actually believe that it's not happening to us.
Right.
And it is. It is. We just happen to have so much undying faith in the Bureau of Labor Statistics, the Ministry of Truth, if you will. It's frankly mind-numbing to me, Kevin.
Well, David, I hope that it doesn't sneak up on you and I and our client base. So let's just make sure that we see the inflation coming, take care of business before it happens like the rest of the world. Thanks for joining us today, David, from Orlando, and I know you're headed to the Bahamas. We'll just go ahead and close it from here. You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick, along with David McAlvany. You can find us at McAlvany.com, McAlvany.com, or you can call us at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.